Hey everyone, Dave Keller here, the Chief Market Strategist at StockCharts.com, and welcome to this special edition of the Final Bar. It's helpful every once in a while, maybe once a month or so, to take a step back from the flickering ticks of the markets, look a little more big picture. And what I wanted to do today was share with you the top 10 charts to watch in August of 2023. Now, the first half of 2023, undeniably one of the strongest eras in modern financial history, it's felt like. And in the face of strong recessionary pressures, the Fed raising rates, it's been a fascinating market, really driven by a small number of mega cap names. After June into July and now going into August, the question is, do you see an exhaustion in those mega cap growth stocks? Do they take a bit of a breather? What does that mean for the major benchmarks? And do we see a rotation of sorts, a leadership rotation, where some of the stocks and sectors that have been struggling and underperforming actually start to take a little drive in the driver's seat? Remains to be seen, but I think if you follow these 10 charts in particular, you won't miss out on the opportunities as they come. As a reminder, the Final Bar is our show that runs every weekday after the close. If you missed any of our recent interviews, including a lot of guest hosts, which have done a fabulous job, make sure you go through some of our previous episodes on our YouTube channel or on StockCharts.com. Just click on Stock Charts TV and you can see all of the different shows, including this show, The Final Bar. Let's get to the top 10 charts for August 2023, and we're going to start with a weekly chart of the S&P 500. Now, this is a pretty straightforward chart looking at the last 5 years, but the reason why I wanted to start here is because we are now getting into a potential situation where we have to talk about a double top pattern. Now, a double top pattern is a classic charting technique, essentially where the market sets a high, pulls back, and then goes all the way back and 100% retraces back up to the previous high. And that test of resistance, that retest of the previous highs, if it fails there, is known as a double top. And it's essentially the most pure form of a market setting a resistance level and then facing that resistance soon after. When we're talking about a double top pattern with the S&P, and I'm looking at a weekly chart here, I'm talking about the high from the end of 2021, the beginning of 2022. What's interesting is the S&P actually made a new high in January of 2022, while most other things actually were sloping downwards. If you look at the Nasdaq composite, look at the Russell 2000 small cap index, look at measures of breadth or momentum, most of those were actually making a lower peak in January of 2022, while the S&P was making a higher peak. A bit of a foreshadowing for one of my other top 10 charts, I think. But as a reminder, that's kind of where we're keying in on. The S&P topped out just above 4,800, and that's kind of the general level that we're talking about. You know, in late July, we're actually getting up above 4,500, threatening to retest that level. And arguably, if you take a step back from this chart, we're pretty close. We're sort of within the range that we were in November and December of 2021. So, what would a double top potentially look like? Well, as a general reminder, what you want to think about is, where did we face resistance before? Look at the final bar, the current bar, look to the left. What key levels stick out? And that 4,800 top sort of looms large right now on the chart of the S&P 500. What's the likelihood of a top here? Well, if you ask someone who's looking at the macroeconomic environment, they would say probably incredibly strong, because the fact that the market has rallied so strongly in the face of clear recessionary fears, the Fed raising rates and potentially getting inspired to raise rates more aggressively through July and maybe even beyond. When you think about where interest rates are and how growth stocks have performed, even with the 10-year yield well above where it was a couple of years ago, all of those things kind of suggest that this market is leaning over its skis. Forget about overvaluation, right? Look at any traditional valuation metric, and these mega cap growth stocks are far exceeding sort of a reasonable level based on traditional valuations. But this does not seem like a normal or traditional time. So the reason why I think this chart is helpful is just to remember that we are facing a double topping pattern. The question I ask myself as I'm looking at this chart are, what are the conditions now versus what the conditions were in late 2021, right? Think about late 2021. This is really, heating, the initial rally off of the COVID lows had happened. This is more of the sustained rally. 2021, a very similar period where you had mega cap growth, sort of the FANG stocks really driving returns higher. You had minimal drawdowns, which is similar to what we see in 2023. We continued to push higher. Having said that, the Fed was actually keeping rates very low. So this is a liquidity-driven bull market, meaning that the Fed was continuing to inject liquidity in the system, allowing the market to go higher. That changed in 2021, where it was a liquidity-driven bear market phase. The Fed all of a sudden hits a big pause button, starts to withdraw liquidities from the system. You can see prices going back down. What essentially happened is the market started to show signs of optimism. The AI craze really fueled, I would argue, the last 6 months of a rally for the S&P and the Nasdaq. So the question is, now we're in a condition where the Fed is raising rates, where the economy is slowing down by what they're, in no small part based on the actions that the Fed is taking. The Fed is really trying to slow things down and to get inflation under control. Those are the types of pressures that tend to make things more expensive, tends to weigh heavily on growth stocks, but we're not really seeing that. So there's a disconnect. Is the market just ignoring recessionary fears and inflation that is still not too low, or is this the rally essentially a great sign of optimism that things are getting better and it's a soft landing and things just improve from here and the economic data just starts to improve after that? It's an open question. I think this chart could be key to pay attention to a retest of all-time highs in the S&P 500. The other important thing to notice on this chart, by the way, is look at how far prices could come down and still be within a pretty reasonable uptrend. Take the low in October of last year, connect that to the low in March of this year. You can see that currently lines up around 4150, 4200, which means we can pull back another 300 points or so and still make a higher low according to this trend line. The first Fibonacci support level based on the 2020 to 2022 rally, it's all the way down here around 3815. So again, we can go all the way down to the March 2023 low and still be above that first Fibonacci support. So there's a lot of room below current levels to still be within arguably a consistent bull market phase. The second of the top 10 charts that I would follow for August of 2023 is what I call my market trend model. I learned a long time ago as I would often look at the S&P 500 weekly chart, and just make some basic assessments. What's the bull or bear market call based on the trend, right? Is the trend up or is the trend down? And I realized for me, there was the time frame I was wanting to focus on, which was a couple months down the road, we'll say 1 to 3 months. But then there was a much larger time frame, multiple years, right? And this is sort of the business cycle of things coming in and out of favor. I realized that the time frame I'm operating on is also part of that larger time frame, right? It comprises pieces of that larger time frame. There's also a shorter term time frame, sort of that swing trading time frame, a couple days to a couple weeks. And recognizing that my ability to understand the next couple months was really also thinking about that tactical time frame. So I created this model using weekly exponential moving averages to really quantify the trend on a long-term, medium-term, and short-term basis. The reason why I think this is an important chart to watch in August is because as of mid-July, the trend is positive on all three time frames. The long-term model turned bullish at the end of March of this year. The medium-term trend has been bullish essentially since November of last year. And the short-term model has been bullish since March, since that last sort of pullback off of the February peak and then the resumption of the uptrend. So overall, my market trend model has been all bullish since the end of March of this year, which is a pretty long time. So what happens if and when, and it's really not if, when an extended uptrend starts to rotate, what do you see? Easy example is just to look back at the 2022 peak. And again, not assuming or implying that we get an exact repeat of that, but it does sort of show a classic combination of how my market trend model tends to change when the trend starts to change as well. And you can look back at the 2020 peak as well, and it's a similar sort of general thing. So in order, it will go short term, then medium term, then long term. And that's just by design, right? The short-term model is looking at when the price closes below the 5-week EMA, and that's the first level it's going to hit in an uptrend where it's above all of these moving averages. First thing is it'll break below that threshold. That would turn my short-term model negative. The next thing that could happen is the medium-term trend model turns negative. That, for me, is looking at the 5-week and 13-week exponential moving averages. They cross below one another. This histogram goes below zero. That tells me that medium-term time frame is now bearish. The long-term time frame often takes a long time to rotate lower because it's really looking at long-term averages, the 21 and 34-week EMAs, which take quite a bit of time to rotate lower. On my chart above, this is the red and purple lines here. So the long-term model would be the last thing. And if and when that would rotate, that would basically tell you this is a significant drawdown, one of the most major cyclical drawdowns that you would see in quite some time, and would tell me to be, if I'm not defensive by then, to certainly be super defensive and just wait for things to ride out. The way that I think of this is the medium-term model is sort of my main risk-on versus risk-off model. So as long as that remains above zero on any sort of pullback, things are okay. So back here in December or in March, where it went just right to that zero line, sort of held there and then rotated higher, that told me conditions were not that bad. It was actually holding in all right. But if and when you get a break below the zero level, that's what tells me probably a more significant top. So I think this is an important chart to watch. First off, to see if the short-term time frame would rotate, then the medium term would be second. The third of the top 10 charts to watch in August 2023, stocks versus bonds. So much discussion about equities and whether stocks, which have already had a good run in 2023, can continue. The question is if things start to get negative, right? If things turn south in August, which seasonal trends would tell you is highly likely that in August, September, somewhere in there going into October, most likely have a pretty meaningful pullback. That's what the average pre-election year usually does. So if that does happen, well, where do you go? There's a big argument for going to the relative safety of bonds. Unfortunately, the data for the last couple of years really doesn't support that. If you look at 2020, the second half of 2020 into 2021, you can see stocks performed bonds pretty consistently. Now, that's during a bull market phase. Kind of makes sense, right? That stocks as more risky assets would probably outperform. But in 2022, stocks were coming off. Bonds were coming off as well because the Fed's raising rates. So as a result, stocks continue to outperform bonds. In 2023, another bull market phase. Again, you're seeing stocks outperform bonds. Now, there have been some pullbacks, but look at how it's remained above the 200-day moving average, this ratio, really since summer of 2020. So I think this is an important chart to watch. Number one, as a reminder that even if stocks start to come down, you're probably better off looking for more defensive areas of the equity space or other asset classes like commodities, maybe cryptocurrencies, as opposed to bonds. Bonds have really not been a great defensive play just because of the fact that the Fed is in a rate hike cycle. Now, that could change, and I think going into the end of 2023 into 2024, we'll be talking about the Fed, sort of ending the rate hike cycle, the prospects of lowering rates at some point if economic conditions continue to improve, or if the economy, slows down, inflation comes into check, and sort of an all clear for the Fed to go back to more of a normal policy and a sort of normally steep yield curve. But for now, this ratio tells you that it's still stocks over bonds. So I think it's an important one to remember the history, but also as an indication, if and when this ratio breaks below the 200-day moving average, that would tell you that relationship of stocks over bonds, which has been fairly consistent for 3+ years now, is maybe starting to change. So that's my third chart to watch in August. Chart number 4 to watch in August 2023, Amazon. We'll look at just 2 individual stocks. I thought about how many individual names I would want to include in here, and this is one of those that I thought would be really helpful. This is looking at basically the price of Amazon in the top panel. The middle panel is looking at the RSI, the measure of momentum. Bottom panel is looking at the relative strength, Amazon versus the S&P 500. Look at how the price in June, mid-June, early June, late June, and mid-July coincides with lower momentum readings. This is called a bearish momentum divergence. Often happens at the end of a bullish cycle where the price continues to go higher, but instead of the momentum showing you that there's additional demand coming in, the momentum actually rolls over, and this is what causes prices to go up, momentum to slope downwards. That is a bearish momentum divergence. The reason why I think Amazon is an important one, of course, it's one of the FANG stocks, one of the mega cap growth names that have done so incredibly well. Made a new low in January of this year and then pushed higher. And besides a brief pullback in February into early March, overall has been a resilient stock, breaking above resistance, continuing to make higher highs and higher lows. I'm watching this chart here in August to see if that divergence plays out. And what you would see if that's the case is the momentum would go lower. The RSI would go below 50, 40, even further. The price would stop making higher highs and would start making the lower peak. Instead of holding above an ascending 50-day moving average, it would break below. When I think about what has driven this market in the first half of 2023 and what could lead our major benchmarks lower in the second half of 2023, it's all about the big cap, the mega cap growth stocks, things like Amazon and others. We'll show another one here in a moment. But I think Amazon probably setting up with the most classic potential divergence signal here in late July. And I think the question mark for August will be, do we get a follow through to the downside? And if so, if a chart like Amazon can't hold its 50-day moving average, the major benchmarks don't have a lot of a further upside potential beyond what they've had already. So that's the fourth chart I would be watching. Chart number 5 of the top 10 charts for August 2023, Alphabet. This is the second major name, of course, one of the other FANG stocks. But what's interesting about the chart of Alphabet is out of all the FANG stocks that I would review, this is the one that actually looks the least bullish as of late July. And I'll tell you what I mean. Remember that divergence we just looked at with the chart of Amazon? On the chart of Alphabet, you actually see a divergence that has already played out. And this is why I think it's an important one to remember when you're looking at the chart of Amazon. Look at the high in May, and then the higher high in early June. Look at the price momentum, the RSI, making a high in mid-May and then a lower peak in June. That that pattern of higher prices and lower momentum is called the bearish momentum divergence. That tells you that conditions are not as attractive as you might assume, given the fact that prices are making a new swing high. What's more compelling about Alphabet is what's happened after that. Alphabet has actually made arguably a lower peak. And in mid-July, you actually made a lower peak. And now we've pulled back and we're testing the 50-day moving average. So I mentioned with Amazon, a bearish divergence, a lower high, and a breakdown of support or breakdown of the moving averages. You're actually starting to see some of those things already checked off if you had that same checklist and applied it to the chart of Alphabet. So I think Alphabet might be an interesting early warning signal, maybe one of the first of the FANG stocks to break down. And my question for Alphabet going into August is, do we see a further deterioration? Alphabet below 115 would complete that rotation, would check all those boxes of a trend that had been bullish and is now starting to rotate lower. So chart number 5 is Alphabet. By the way, a quick reminder, if you want access to these 10 charts, if you are a Stock Charts member, you absolutely can. We have a link in the description before. Click on that link. If you're a member, you log into your Stock Charts account and you can copy this chart list to your own login. You'll have all these charts available. You can watch real time as these charts evolve in the way that we're discussing. Good time to be a Stock Charts member, by the way, to have access to cool charts and visualizations like that. Let's get on to chart number 6. Financials versus technology. If you look at the XLF to the XLK, this is part of a chart list that I have on Stock Charts called ratios. And I love looking at different ratios to think about the relationship between different charts. And the reason why I started looking at ratios more and more, it started out with early in my career, I spent time with a swing trader, really a pairs trader in Connecticut. He was at a hedge fund. And pairs trading is basically, instead of making a directional bet on a particular stock or ETF, I think this is going to go up or this is going to go down. A pairs trade is basically being long one thing and short the other. And you're not betting on either of them to go up or down. You're looking at the relationship and you're looking at whether one is going to outperform the other or the opposite. And so you're really betting on the ratio doing a certain thing. I also spent some time with asset allocation managers, money managers who were looking at bigger picture themes like stocks versus bonds, commodities versus equities, thinking of different global regions and what was outperforming what. And by looking at a series of ratios, you're able to quantify that relationship and most importantly, identify when that relationship was changing. So when I'm looking at the ratio of the XLF to the XLK, look at how in the second half of 2022, technology was really struggling on a relative basis, particularly relative to the financial sector. Banks actually started to recover a little bit while technology was getting beaten down pretty good. 2023, that changed in a big way. The tech sector has been the strongest sector in the US market in 2023, and it's not even close. It's been tech versus everything else. And as a result, financials sort of languishing, basing as rates have remained fairly elevated, has caused this ratio to go down. This shows you how financials are underperforming technology by the fact that the ratio is going lower. Interesting things happened here in June and July where that ratio has actually started to stabilize a little bit. And when I think about what a market could look like if we get a pullback, right? Let's assume that that double top in chart number 1 plays out and the S&P doesn't get much above 4,800, if at all. Let's say that those growth stocks like Amazon and Alphabet, which have been really leading the market higher, start to come back and those bearish divergences really play out and they start to rotate lower. What happens next? Well, I would argue that because our benchmarks are so growth oriented, those mega cap stocks are such a weight, that if they come down, the benchmarks are going to get dragged down as well, regardless of what everything else does. But there could be a situation where some of the more value-oriented parts of the market, like financials, like industrials, like materials, even something like healthcare, could actually do quite well. The benchmarks, the S&P and the Nasdaq, most likely still go down in that situation, but there could be areas of the market where the stocks are actually going up, and some stocks and ETFs are actually doing just fine, even though the market, the benchmarks, are going lower. And it's less about there are no stocks going up and more about the stocks that are going down are just the biggest ones, and that's weighing the benchmarks lower. That's why a lot of stocks were not going up in the first half of 2023, but the benchmarks were, because the biggest stocks in the benchmark were doing fine. We could see the opposite, where Amazon, Alphabet, and other names like that start to rotate lower. This chart could be a great indication of whether that's happening, whether we're getting a leadership rotation that should compel you to lean away from some of the growth leadership that's been so dominant in the first 7 months of 2023, and maybe pivot to some of those areas of the market that have been struggling, things like financials or healthcare, industrials, materials, energy, some of those areas of the market. Now, I would argue more than anything, look at the chart and see when the charts tell you or compel you to visit some of those themes. But I think this ratio of financials versus technology could be a pretty interesting one to watch to see if we get an uptick in that ratio. Chart number 7 of the top 10 charts to watch in August 2023, utilities. When I think again about leadership rotation, what would tell me that we're rotating or investors are rotating away from what has been working more into other areas of the market? Well, one scenario is that it's just a rotation from growth to value, a rotation from technology to financials, from communication services to industrials or materials, and sort of rotating to other areas of the market that have been underperforming. A different scenario could be things really start to come off, and not only do the growth sectors come down, but some of those cyclical sectors like industrials start to come down as well. All of a sudden, everyone's selling risk assets because they're afraid of losing everything. What would happen in that scenario? You'd start to see an improvement in defensive areas of the market, things like utilities, real estate, consumer staples. I'm looking at the chart of utilities here. This is a chart I drew from my monthly chart review, which is an exercise I do with my market misbehavior premium members once a month. And what we look at are the 11 S&P sectors with this set of charts. The top panel, this is a weekly chart, the top panel is the relative strength of utilities versus the S&P. This line is going up, utilities are outperforming. The line is going down, utilities are underperforming. Here's the price of the utilities ETF XLU on a weekly basis for the last 5 years. And then here's the momentum, the RSI on weekly data for utilities as well. And I tend to focus most of my attention on this top panel because my main goal with this chart is to see what sectors are outperforming and what sectors are underperforming. Now, if you look in the first half of 2023, there's only 3 sectors and really only 2 that were dominating the relative performance: technology, communication services. Consumer discretionary, maybe third on that list, but not as successfully as those first 2 sectors. One of the sectors that has not done particularly well is utilities. Utilities have been underperforming, and again, it makes sense. It's a sort of low volatility, higher income defensive sector. So you really only own utilities if you want to not own some of the offense, right? If you need to be in equities for some reason, right? You have an allocation requirement to be in equities, but you don't want to be in the growth leadership names because the market's getting disrupted, you rotate to something defensive like the XLU. This is why utilities outperformed in the first half of 2022 when the market was really struggling, because it was a good place to hide out as everything was kind of coming down. Utilities have been underperforming. I think that one of the reasons to watch this chart going into August is to see if the relative strength starts to improve. This might be a good way to do it. Julius de Kempener's RRG, the relative rotation graph, is another brilliant way of visualizing that rotation. Do you see the rotation away from growth and into defensive sectors like utilities or REITs or consumer staples? Only when the relative strength improves in those areas of the market do I think they deserve your attention and your capital. That's why I think this ratio chart, looking at the XLU's relative strength, would be an important one. For now, not really seeing enough of an improvement in the relative strength to deserve further attention. But this is a chart to watch in August, because if you do get a rollover in the traditional seasonal sense, and other equities, other potential leadership groups languish, utilities may be an interesting place to hide out. This brings us to the last couple charts, which I think are really about timing a potential market top. And again, I'm skeptical of further upside for equities in July into August and September. It's seasonally one of the weakest parts of the year in any year, but especially in a pre-election year, it tends to be pretty weak. And so I'm anticipating a bit of a drawdown, a bit of a pullback. And the way that you can confirm when that's happening is to use a breadth indicator like the McClellan Oscillator. If you're not familiar with the McClellan Oscillator, it basically is an indicator based on advanced decline data. So advanced decline data, basically at the end of every trading day, you can calculate in a group of stocks like the S&P or the New York Stock Exchange, a broader universe, how many stocks closed up and how many stocks closed down. And that is a daily advanced decline number. Now, you can look at that over time. It's called a cumulative advanced decline line, where you add or subtract the net change in advancers versus decliners over time. And all of a sudden, you get a data series showing the trend in advancers versus decliners. And usually that tends to match what you see with the S&P 500, the major benchmarks. What McClellan did, and this is Sherman McClellan that created this indicator with his wife, I think Cheryl McClellan. I'm sorry, I forget her name. That's probably wrong. I'm so sorry. Marion McClellan. I should know that. But the McClellans created this indicator, which was basically taking moving averages, exponential moving averages of the raw cumulative advanced decline data, turning it into an oscillator. And that's why we call it the McClellan Oscillator. If this indicator is above zero, then the conditions are bullish. If the indicator is below zero, the conditions are bearish. And very simply, it's looking at the change, the rotation in that advanced decline data. I've used the annotations platform on stock charts just to color code. If it's above zero, I highlight it in green. If it's below zero, I highlight it in red. And I skipped some of these times where it's just a one-day move. I'm looking for more of a follow-through above those levels, and that's why I have these levels shaded. You had a brief pullback of a couple days in mid-June, but after that, we went right back to above zero. And overall, for the month of June and July, this has been pretty bullish, basically indicating uptrend or strength over weakness. I would be looking to see if and when the McClellan Oscillator goes back below zero. If you look back at the major drawdowns over the last couple of years, they have been confirmed with the McClellan Oscillator going below zero. If it doesn't go below zero, it's usually not much of a pullback. Gets below zero, that often happens right before, not way after a top, but actually pretty soon, pretty early on. In the pullback phase, you'll see the McClellan Oscillator turn more negative. And I think that's why it's a really important chart to watch. If we do get that seasonal weakness, it'll be reflected on this chart with the breadth conditions starting to deteriorate. My ninth chart out of the 10 charts to watch in August 2023, the Bullish Percent Index. This is a breadth indicator based on point and figure charts. If you're not familiar with point and figure charts, go to stockcharts.com to our chart school. We have a whole primer on point and figure charting, how the charts are calculated and what they mean. It is a shorthand trend analysis tool that traders on the floors of the Chicago exchanges, when they still had floors that were active, I used to go down there in my Bloomberg days and spend time with traders who literally would hand draw point and figure charts every day and use those as a way of just understanding the overall trends in futures and commodities. Now we can take those point and figure charts and adapt them into breadth indicators. Abe Cohen, who ran a firm called Chartcraft, created this idea called a Bullish Percent Index. Basically, it's looking at the 500 stocks of the S&P 500 in this case, and basically saying what percent of them have a bullish point and figure chart. And a point and figure chart is either bullish or bearish based on a traditional set of buy and sell signals, and so you can calculate what percent are bullish, and that's what this is telling you. In mid-July, you're getting up into 75-80% of S&P 500 members that have a bullish point and figure chart. Now, on the surface, that's pretty bullish, and that's true. That actually means most things are going up. That's kind of what a bull market should look like. But if you look back, I've highlighted in red the previous times over the last 18 months when this indicator has gone above the 70% level. That on its own is not bad. That usually means the prices of the S&P is going up in a big way. But look at what happens when we come out of that 70%, right? Come back below that overbought threshold, and you can see again that tends to confirm some pretty meaningful pullbacks, and that's like in a downtrend year, in a bearish year like 2022, but also in a bullish phase like 2023. The indicator going above 70%, then coming back below, has often been a really good sign of a meaningful pullback. In some cases of a couple weeks to a couple months. So as we see this market accelerating into the summer And going into August, I'm very keen looking at the McClellan oscillator and also this indicator called the Bullish Percent Index to see if we break back and really see when we break back below that 70% level. If you're looking for a confirmation that a pullback is likely and has most likely already started, those last two charts, the McClellan oscillator and the Bullish Percent Index, those are the two I'll be watching to confirm that drawdown has engaged. That brings me to the last of the 10 charts to watch, top 10 charts to watch in August 2023, what I call the new Dow theory. Now, I recorded a YouTube video on my channel called Market Misbehavior, called Dow Theory for Beginners. I would check that one out if you want more information on what Dow theory is and how it works. But to summarize, Charles Dow over 120 years ago created what is now known as Dow theory, looking at the Dow Industrials and the Dow Transports to see if they both confirmed one another. If those indexes are both going up, that's a bullish phase. If those indexes are both breaking down, that's a bearish phase. If there's disagreement, one breaking out and the other not confirming, that's called a bearish non-confirmation. If you look at this chart, you can see that in November into January, November 21 to January 2022, index number 1 making a new high. Down here, index number 2 making a lower peak, and that's what's called a bearish non-confirmation. Now, you'll note I'm not looking at the Dow Industrials and the Dow Railroads. I'm looking at two other ETFs. So here's what happened. Dow theory was Dow Industrials and the Dow Railroads. Really modern indexes that track those are the Dow Industrials and the Dow Transports. The problem is the industrials and the transports really don't mean the same thing in 2023 than they did in 1903, which is more the era that Charles Dow was operating under. So a more modern take on that would be the S&P 500 and the Nasdaq Composite, sort of the old economy versus the new economy. In both of those, you had that same bearish non-confirmation at the end of 2021, indicating that the uptrend was questionable. But the problem right now in July into August of 2023 is it is a very top-heavy market. So the S&P and the Nasdaq are both dominated because they're market cap weighted. They're dominated by those mega cap stocks. So how do you come up with a good comparison of two different groups? I'm using equal weighted ETFs. I'm using the RSP, which is an equal weighted S&P 500 ETF, and the QQQE, which is an equal weighted Nasdaq 100 ETF. You can see again, these indexes had a non-confirmation. The S&P equal weight made a new high in January. The equal weighted Nasdaq did not, actually made a lower peak going into the beginning of the year. You can see as of mid-July, you see that the Nasdaq equal weighted Nasdaq made a new high at the end of May. The S&P equal weight just barely maybe making a new high here in mid-July. The reason why I think this chart is important to watch is number one, do you get that bullish confirmation with both of these indexes making new highs for the year? Number two, do you start to see a bearish non-confirmation when one of them makes a new high and the other one does not confirm it? That could be a sign of market exhaustion, of a bull exhaustion, which is classic, a classic pattern we've seen in numerous bull market phases at the end. That exhaustion point is marked by a Dow theory non-confirmation. So chart number 10, new Dow theory to get a non-confirmation and or a bearish rotation as these indexes both start to break down. Those are my top 10 charts to watch for August 2023. As a reminder, if you're a Stock Charts member, there's a link below the video in our description. Click on that link. You'll go to the Stock Charts website. Make sure you log in. You'll be able to access all of these charts, save them to your own login. If you're not a Stock Charts paid member, what a great time to do so. Click on the link. You can set up a free trial. You'll be able to access the charts during your free trial, and I hope you find that it is well worth your time and investment to become a paid member of Stock Charts. For Stock Charts TV and StockCharts.com, I'm Dave Keller, Chief Market Strategist here at Stock Charts in Redmond, Washington. Be well, stay safe. We'll talk to you again soon.